KennethLFisher, How to Smell a Rat, The 5 Signs of Financial Fraud. Dive into the world of financial fraud and learn how to protect your hard-earned assets with this summary of How to Smell a Rat, The 5 Signs of Financial Fraud by KennethLFisher. Through real-life examples, such as the infamous case of Bernard Madoff, this summary will teach you the importance of appointing an independent custodian and how to spot the telltale signs of shady financial advisors. Equip yourself with the knowledge to navigate the complex world of money management and ensure your investments are safe and sound. Find the keys to recognizing fraudsters and learn valuable approaches to make smarter investment decisions.
Protect your investments. Avoid investment fraud by using a custodian to safeguard your money and assets. Investment fraud can happen to anyone, including celebrities and charities who trusted Bernard Madoff with their money. The common thread across investment fraud is that a financial advisor has control of the assets. To avoid a similar fate, it is important not to place your money and assets into just anybody's hands. Instead, employ a custodian, which is a financial institution that safeguards your securities either physically or electronically and keeps you informed about your accounts. Custodians act as a buffer between your money and the financial advisor, minimizing the risk that your money will be stolen or squandered. With a custodian, you can access your accounts online 24/7, and they also provide their own account statements, which you can cross-check with those your investment advisor provides. However, if your custodian is also the person who makes your investment decisions, you're in trouble. Giving your financial advisor custody of your funds to invest them directly enables them to line their own pockets with your money and cover their tracks with false or misleading account statements. Without an independent custodian statement with which to compare your statements, it's easy for you to be scammed, and hard for you to do the math. In summary, to protect your investments from fraudulent activities, ensure that you employ a custodian to safeguard your money and assets, as the custodian acts as a neutral third party between you and your financial advisor. Signs of deceptive investment managers. Be cautious of investment managers who promise consistent, incredibly high returns or boast of consistent above-average track records. Extreme returns are not the norm, and even the best money managers have their bad years. Investing in the market can be risky, and trusting your money with an investment manager adds another layer of uncertainty. The author of the book warns readers to be cautious of certain warning signs that could indicate a deceptive investment manager. One of the main red flags is an investment manager who promises consistently high returns, especially returns of 40 or 50%. These types of returns are not realistic and have only been promised by master fraudsters in the past. While it's possible for an advisor to have a few years of extraordinary returns, it's highly unlikely that they could consistently beat the market by such a high margin every year. Another red flag is a consistent above-average track record. Markets are volatile, and experiencing extreme returns is more common than consistent above-average returns. In fact, 2/3 of S&P 500 annual returns have either been below 0 or above 20%. Even the best money managers have their bad years, and it's crucial to remember this when assessing the success of an investment manager. By being aware of these warning signs and using them as a guide, investors can make more informed decisions about who to trust with their money and avoid falling victim to deceptive investment managers. Understanding investment strategies. Investment jargon can be confusing, but it's essential to understand your investments. Don't invest in a strategy you don't understand, and be wary of advisors who can't explain them in simple terms. Strategies are like blueprints, while tactics are tools to achieve them. Beware of flashy tactics marketed as strategies, as they may be scams. Always ask for a clear investment strategy before investing. Exclusivity and its perils. Exclusivity isn't a good enough reason to choose an advisor. It neither brings down fees nor guarantees better returns. A client must question the investment tactics of the advisor and refrain from getting swayed by displays of opulence. Access to an elite group of investors is certainly desirable to many as it brings along a sense of achievement, just like being accepted into an exclusive social club. However, exclusivity in an advisor could be an expensive pitfall, as was seen in the case of Bernie Madoff, who swindled investors by advertising his funds as exclusive. Investors should not be carried away by the so-called elite tag and must steer clear of advisors who carefully curate their clientele for unclear reasons. Although some advisors prefer dealing with certain investors based on investment size, exclusivity on its own is an insufficient reason to choose an advisor. Further, flashy displays and extravagant expenditure should not be a measure of an advisor's competence. Instead, it is essential to ensure that the advisor's investment tactics meet the client's interests. Any expenditure an advisor makes reduces the client's profits, and hence, flashy displays could indicate incompetence or an attempt at distraction from the advisor. Therefore, a good advisor spends his time on investment strategies that bring profits rather than on expensive toys. The hidden cost of financial advisors. Financial advisors claim to work for free, but they always find a way to get paid. If you don't pay them, they'll receive kickbacks from other sources, creating a conflict of interest. Additionally, advisors who only earn from transaction costs may push trades that don't benefit the investor. Reputation is not a reliable indicator of trustworthiness, and even con artists can buy respectability with charitable donations. It's essential to understand how your financial advisor is being compensated and to prioritize your best interests when managing your money. Choosing a financial advisor. Choosing a financial advisor solely on friends' recommendations can be risky as it may not be the best option. One should take time to select a trustworthy advisor as fraudsters exploit the tendency of people to trust referrals from friends. Belonging to the same peer group does not necessarily guarantee a capable and trustworthy financial advisor. It is important to scrutinize the credibility of an advisor instead of blindly trusting any referral from friends or acquaintances. SEC's role in protecting investors. The article sheds light on the role of the Securities and Exchange Commission, SEC, in ensuring transparency among big-time advisors, scheduled inspection, and enforcing securities law. The SEC mandates that investment advisors disclose all material information in the Form ADV, but sometimes it fails to detect fraud ahead of time and lacks the resources to monitor all registrants all the time. A thorough inspection can take time, and some documents could be filled with misleading data. Therefore, while SEC monitors degenerate firms, investors still need to diligently vet their financial advisors to stay safe from fraud.
In conclusion, How to Smell a Rat, The 5 Signs of Financial Fraud, by Kenneth L. Fisher arms you with the tools to identify potential financial scams and helps you safeguard your investments. This summary underlines the significance of thoroughly vetting your financial advisor, employing an independent custodian, and scrutinizing their track record to avoid falling prey to fraudsters. Remember, consistent above-average track records and a lack of transparency in strategies are red flags. Always do your due diligence and question gaudy displays of wealth or an exclusive clientele. Ultimately, the responsibility of protecting your investments lies with you, and this summary helps you stay vigilant and make well-informed decisions in the world of money management.